I'm Jonathan Broadbent, founder and creator of Unwoke Academy and the Financial PMA, with another Market Minute. This one focused on energy. The first thing to know about energy is that there are two main components of it. One is the production or the creation of energy, and that's usually a coal-fired plant or a nuclear facility or something of the like. And separately, there is the distribution of energy. That's the company that distributes power out to the consumer. That means you and companies near you. It will probably come as no surprise to you that major investment management firms like BlackRock have been buying up power companies, and yes, that means both components, the creation and distribution of that power, and now we're starting to wade into some really tricky waters. In case you weren't already aware, BlackRock is aggressively acquiring U.S. utility companies to capitalize on surging electricity demand from artificial intelligence data centers. Through its Global Infrastructure Partners division, BlackRock is pursuing several major deals, with the most prominent being a $33.4 billion acquisition of AES Corporation, alongside Swedish firm EQT AB, and a $6.2 billion buyout of Elite, which is the parent of Minnesota Power. And there it is again, with the help of Canadian Pension Plan Investment Board. There's that investment of retirement savings into the build-out of things that we, the people, generally don't want. These transactions represent a shift by private equity firms to own critical energy infrastructure outright, rather than holding minority stakes. Proponents argue that these deep-pocketed investors, that means you, provide necessary capital to modernize grids and meet state carbon-free mandates, such as Minnesota's 2040 goal. So let's unpack that for a moment. BlackRock doesn't have very much money by themselves. What they have is your investment dollars that you have given to them to invest wisely for your future. You being in the aggregate, we the American people have given BlackRock and companies like them the authority to choose what to invest in. BlackRock clearly is among many companies that are choosing to invest in many of the things that we the people do not want. That means that you are being utilized as a slush fund, a piggy bank, to build out AI data center infrastructure and the power that supplies them, and many of the other ancillary connected components like flock cameras, smart meters, smartphones, and the like. If you don't agree with those things, by all means, don't allow your money to go toward funding them. Conversely, consumer advocates and some regulators warn that private equity's extractive business model and target returns of 15 to 20% could lead to higher electricity bills, reduced transparency, and a prioritization of investor profits over reliable, affordable energy service for residents. Put simply, what that means is prioritizing AI data centers and their energy needs over the needs of the individual consumer. And now on to a couple of the key transactions and their current status. AES Corporation acquisition, a consortium led by BlackRock and EQT, agreed to buy AES for $33.4 billion, including debt. This deal significantly expands BlackRock's fossil fuel holdings and targets utility assets in states like Indiana and Ohio. Elite, which is part of Minnesota Power, BlackRock and the Canadian Pension Fund secured regulatory approval in Minnesota to take the publicly traded holding company private, which means that they will take it off market and make it a privately held company. The deal faced fierce opposition from consumer groups who feared rate hikes, though labor unions and clean energy groups supported it for its access to capital. Again, by capital, what that means is your investment dollars. BlackRock and rival Blackstone are also seeking to acquire utilities in New Mexico and Texas. BlackRock has also acquired solar developer Summit Ridge Energy and holds minority stakes in various other energy firms. While the Federal Energy Regulatory Commission, or FERC for short, has renewed BlackRock's ability to hold utility shares, state regulators are increasingly scrutinizing the deals due to concerns about monopolistic control over captive ratepayers and the potential for ratepayer-funded profits. That is, in my estimation, a landscape that is ripe for abuse. And it means, in particular, multifaceted abuse of you, we the people. First, we have companies like BlackRock that have a significant stake and vested interest in AI data centers and their profitability that are funneling money into buying up the energy suppliers that are very soon, or actually currently, being tasked with trying to draw more energy away from residential use and redirecting it into the ready availability of AI data centers. Then you have the fact that BlackRock is utilizing the money of we the people, our retirement savings, to fund the thing to begin with. That is a three-headed Cerberus snake if I've ever seen one. So step one, if you don't agree with these things and don't believe that your money should be going toward funding them, is to take your money out of BlackRock, Vanguard, State Street, and others. There are better alternatives and better ways to invest that are clearer, more transparent, and avoid some of the fees that are assessed in connection with some of those investment managers. And that actually may be a fourth head to the snake. The fact that you are paying for them to do this to you by using your money in inappropriate ways. For more on the evolving topic of AI data centers, flock cameras, smart meters, smartphones, and how they all tie together, remember to click that follow and like button. Follow unwoke.academy. We'll continue to bring you news and information you can use, in particular, in your investment portfolio.